Hello there, good morning. My name is Victor Alui, and I'm the head of investments at Sankore Global Investments. Here is your weekly financial markets roundoff. We start off in the US markets where stocks closed Friday really strong after comments by the Fed chair, Jerome Powell, at its retreat in Jackson Hole, Wyoming, essentially indicated that rate cuts were imminent or were on the horizon. The Dow was up by about 1.14%. The S&P rose 1.15%. To close really very, very close to the record high that had set last month, while the NASDAQ added 1.47%. With Friday's gains, the three major indices posted a winning week. The Dow surged about 1.3%, the NASDAQ was up 1.4%, while the S&P added 1.45% to cap off the week. Again, like I said earlier, stocks really rallied as the Fed chair signaled that rate cuts were ahead. This basically pleased market participants who had essentially bet that the Fed would start, cutting interest rates at its meeting in September. This positive outlook also impacted small caps, with the Russell 2000 adding more than 3% for the week. Also adding to the dovish, sentiments by the Fed was the downward revision of job numbers that we saw last week. Job numbers over the last 1 year were revised down by 818,000. This is the highest downward revision we've seen for jobs since the global financial crisis of 2009. So clearly, this indicates that the job market had not been as strong as we had thought, and that was one of the major reasons why the Fed had essentially held off on reducing interest rates. So with this reduction, it kind of gives the Fed sort of like the all clear to actually go ahead and start reducing interest rates, and the consensus really is that we'll start to see that happen from September. However, there is less of a consensus really around how much of the cuts we are likely to see. There are expectations of 25 basis points. You have expectations of about 50 basis points as well. Again, really remains to be seen, how hard the Fed is, likely to go. There are also, indications or thoughts around the fact that we've got just 3 FOMC meetings left this year, and that the Fed is likely to just implement a 25 basis point cuts at each of those meetings. It really remains to be seen how the Fed, goes about playing this. But I think one thing is clear: we're certainly going to have rate cuts starting in September. For the remainder of the week, really, we've got some macro data coming through. PCs coming through on Friday. Also initial readings for Q2. GDP would also be out this week as well, and also earnings will continue. We'll see Nvidia's earnings this week as well. That is something that certainly the market will be looking out for to sort of gauge how this whole AI frenzy is truly performing, and what's really under the hood of what's going on with the whole AI frenzy. Over in Europe, the major development there was that the EU slashed its plan to basically increase tariffs on Chinese EVs, or EVs that were made in China. It had basically planned to significantly increase those tariffs, but it's now revised those tariff projections downwards. And this was basically instigated by Tesla, where it basically sort of petitioned the EU to basically highlight the fact that it wasn't benefiting from a lot of the subsidies that were in China, and that these tariffs revisions should be looked at again and revised. And sure enough, it was looked at, and these projections were significantly reduced. For instance, the duties on Teslas coming in from China, for instance, is going to be 9%. The initial proposition was that was going to be 20.8%. So that's a significant reduction. We also have reductions from cars manufactured by Geely as well, by cars manufactured by BYD, and also SAIC. So again, if you recall, the Biden administration has slammed a huge tax on import duty on EVs coming in from China, basically just citing the fact that these manufacturers were benefiting from unfair subsidies that gave them sort of like an edge over US manufacturers. And in a bid to sort of protect manufacturing in the US, those tariffs were slammed. The EU essentially also decided to toe the same path. However, we are seeing some sort of revision to those planned tariffs in the EU. Over in Nigeria, the fixed income market really was very, very bullish last week, and it was down to improvements, significant improvements, in liquidity. We saw FAC allocation of about 400 billion coming through last week. Again, we also saw very strong post-auction demand as a result of the fact that a lot of bids were unmet or unfilled. So all of that demand essentially filtered through into the secondary market, obviously supported by the liquidity improvement that we are seeing in the course of the week. So in the treasury bill market, for instance, we saw yields decline by about 24 basis points, for the week on average. We also saw the primary market auction, last week where, the DMO offered about 409 billion across 3 maturities. The auction was really oversubscribed by about 617 billion. DMO undersold by about 118 billion, and then stop rates across the 91, 182, and the 364 day papers all declined by 30, and 98 basis points respectively. So this obviously created the sort of bullish trend that we saw, in the market. It was pretty much the same thing in the bond market as well. We had seen some demand ahead of the auction. People had expected that, or had bets that really we're going to start seeing those rates come down. So we saw some demand, in the secondary markets ahead of that auction. And then obviously in the aftermath of the auction results, we then also saw, demand also, significantly increase, particularly with, the improvements in liquidity and also the reduction in the stop rates that we saw at the bond auction as well as the treasury bill auction. So this is obviously been interpreted by sections of the market really as an end to the high yield environment that we had seen, over the last couple of months. I mean, we've been here a couple of times before. It really remains to be seen if this is, truly it. But in the bond market, yields declined by an average of about 23 basis points for the week. Also, if you look at the bond auction, really, the DMO offered about 119 billion across the maturities, the 29s, the 31s, and also the 33s. The 29s and 31s were undersubscribed, while the 33s was oversubscribed by about 325 billion. The DMO allotted about 325 billion across maturities and oversold by about 184 billion. We also saw, the rates also come down across, our board at the bond auction. So going into the remainder of the week, really, we will expect to see how the fixed income markets carries on. Are we likely to see a continuation of that bullish trend that we saw last week, or we will see a moderation? We think that we're likely to see some moderation this week as market participants assess economic variables that continue to show us where the economy truly is heading. So I think that's pretty much it in terms of our outlook for the week and essentially what happened last week. We'll continue to keep an eye on the situation and certainly keep you posted. Thank you very much for your time. Do have a very productive week. Thank you.